Welcome to Thoughts on the Market, and to part two of a conversation with Lisa Shalett, Chief Investment Officer for Morgan Stanley Wealth Management. I'm Andrew Sheets, Head of Corporate Credit Research at Morgan Stanley. Today, we'll be continuing that conversation, focusing on how higher interest rates could impact asset classes, and also some recent work about the unusually high concentration of stocks within the equity market. It's Monday, May 6th at 4 p.m. in London. We begin with Lisa's very topical question about how higher interest rates might impact credit.
So, Andrew, let me ask you this. From your perspective as the global head of corporate credit research, what happens if we're, in fact, in this new regime of rates being higher for longer?
Yeah, thanks, Lisa. It seems more topical by the day as we see yields continuing to march higher. So I think like a lot of things in the market, it kind of depends a little bit on what the fundamental backdrop is that's driving those interest rates higher. Because, if I think about the modern era for credit, which I'll define as maybe the last 40 years, the tightest that we've ever seen corporate credit spreads was not when the Fed or the European Central Bank was buying bonds. It was not when you had lots of leverage building up in the financial system prior to the financial crisis. It was in the mid-90s when the economy was pretty good. The Fed had hiked rates a lot in 94, and then it cut them a little. The mid-90s, I think, are one of the poster children for kind of a higher for longer rate environment amidst a pretty strong economy. So if that is what we're looking at rates being higher for longer because the economic output of the U.S. and other regions is generally stronger. I think that's an environment where you can have the overall credit market performing still pretty well. You'll certainly have dispersion around that, as not every balance sheet, not every capital structure was created with that sort of rate environment in mind. Overall, if you had to say, is credit more afraid of a kind of a higher for longer scenario, or is it more afraid of growth being a lot weaker than expected, but that would bring low rates? I actually think a lot of credit investors would much rather have a more stable growth environment, even if that brings somewhat fewer rate cuts and higher for longer rates.
One other thing I know that the Global Investment Committee has been debating is this idea between the haves and the have-nots that's been somewhat unique to this business cycle, where there's been a portion of the mega cap and large cap universes who have demonstrated, quite frankly, a total insensitivity to interest rates because of their cash balances or because of their lack of need for actual borrowing. And then there's smaller, mid-sized companies, these smaller cap or unprofitable tech companies, some of the companies that may have been born in the venture capital boom of the early 2020s. How is this have-not debate playing out in the credit markets? Are there parts of the credit markets that are starting to worry that there's a tail?
Yeah, I think that's just a fascinating question at the moment, because we've lived in this very macro world where it seemed like big picture questions about central banks, will we go into recession, what will commodity prices do, is driving everything. And even this week, questions about interest rates are dominating the headlines on TV and on the news. But I think if you peel things back a little bit, this is an incredibly micro market. We're seeing some of the lowest correlations and co-movement between individual stocks in the U.S. and Europe that we have in 15 years. If I think about the credit market is not just sailing into this environment, happy-go-lucky, no risk on the horizon. It's showing some of the highest tiering that we've seen in a very long time between CCC rated issuers, which is the lowest rated main part of performing credit, and single B issuers, which are still below investment grade rated, but are somewhat better. The market is charging a very high premium between those two, which suggests that it is, exactly as you mentioned, differentiating based on business model strength and level of leverage and the like. So this environment of differentiation where the overall market is kind of okay, but you have lots of churning below the surface, I think it's a very accurate description of credit. I think it's a very accurate description of kind of the broader market. And it's certainly something that we're seeing investors take advantage of. We see it in the data. Lisa, you recently published a special report on the consequences of concentration, which focuses on some of these mega cap stocks and how they may present underappreciated risks for investors. What were the key takeaways from that we should keep in mind when it comes to market concentration, and how should we think about that?
The fundamental point we were trying to make, and it really has to do with some of the unintended risks potentially that passive investors may be embracing that they don't fully appreciate, is really through the end of 2023, U.S. equity indices became extraordinarily concentrated, where the top 10 names were accounting for greater than a third of the market capitalization. And, history has shown that such high levels of concentration are rarely sustainable. But what was particularly unique about the era of the Magnificent Seven, or these top 10 mega cap tech stocks, is not only were they a huge portion of the whole index, but in many ways they had become correlated to one another, right? Both in terms of their trading dynamics and their valuations, but in terms of their factor exposures, right? They were all momentum oriented. They were all tech stocks. They were all moving on an AI narrative. In many cases, they had begun competing with one another directly in businesses like the cloud, like streaming services and media, et cetera.
And Lisa, kind of further on that idea, I assume that one counterpoint that you get to this work is that some of these very large mega cap names are just great companies. They've got strong competitive positions. They've got opportunities for future growth. As an investor, how do you think about how much you are supposed to pay up for quality, so to speak? And maybe you could talk just a little bit more about how you see the valuations of some of these larger names in the market.
What we always remind clients is these are great companies, and they have cash flows, footprints, dominant positions, and markets that are growing. But the question is twofold. When is that story fully discounted, right? And when do great companies cease to be great stocks? And if you look back in history, history is littered with great companies who cease to be great stocks. And very often, clients, quote unquote, never saw it coming because they hung their hat on this idea, but it's a great company.
Lisa, any parting thoughts as we move closer to the midpoint for 2024?
The line that I'm using most with clients is that I fundamentally believe that uncertainty in terms of the economic scenarios that could play out from here, whether we're talking about a no landing, we're talking about a hard landing, we talk about a stagflation, and the policy responses to that, whether it's the timing of the Fed and what they do and what's their mix between balance sheet and rates, and then what happens post the presidential elections in the U.S., and is there a policy change that shifts some of the growth drivers in the economy. I just think overall uncertainty is rising through the end of the year, and that continues to argue for a position, as we've noted, where clients and their advisors are particularly active towards risk management and where the premium to diversification is above average.
Lisa, thanks for taking the time to talk. Hope we can have you back again soon.
It's great to speak with you as always, Andrew.
As a reminder, if you enjoy Thoughts on the Market, please take a moment to rate and review us wherever you get your podcasts. It helps more people find the show.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.